Hey, Mick. Yeah, no worries. You can just listen in. It's all good.
All right. Okay,
All
bye.
right, we'll give it just another couple minutes. What'd you
Okay,
say?
I'll be here. I'll be in the meeting, but on mute.
That's
On
fine. That's
video
fine.
no.
If anybody has any questions, just unmute yourself and I'll address any of those.
All right, wonderful. Thank you, Ryan.
Yeah, no problem, Vanessa. Paul, how we doing?
I'm great. How about yourself?
Doing good, man. Doing good.
It's awesome.
I like that hat.
Oh, thank you.
I got plumbers here at my house right now. No kidding you. This is just a virtual backdrop, man. You don't want to really see what's going on behind me, man.
That looks pretty nice. I was wondering where you're at. I was like, wow.
You can download backdrops, man, and then just drop them behind you. So that's a cheat code. Now, listen, anybody who comes on the call afterwards, just don't give them my secrets. All right, it's only for the exclusive few.
Oh wow.
All right.
All right.
Well, listen, I'm going to go ahead just because Mickey is going to go ahead and record this. So I'm just going to go ahead and get started. And if people trickle in, they trickle in, no problem. So I just wanted to get on this call and talk to you all about a couple of these exciting programs that we've got going on. We've just released 2 different down payment assistance programs for our customers to utilize. We really feel like this is going to push customers to potentially move on houses earlier than maybe they would have initially anticipated. And what I mean is, a lot of times what's keeping these people from buying homes is the fact that Texas is an expensive place to buy a house as far as closing costs go. You combine that with the fact that they need a budget for their down payment. And a lot of times, guys, that's just not really palpable as far as, them being able to move in real time on a house that, they reach out to Paul or Jennifer or Vanessa or Mickey or whoever to be able to reach out and be able to move on something or to make an offer on something with confidence. So what I want to go over is these 2 different programs. And guys, I am going to drop just some actual written information on our Facebook page once the call ends so that you all have something to refer back to in writing, because this is going to be a little bit of information. I want you all to be able to soak all this in and be able to, maybe typecast a few of our customers into one of these programs potentially. And again, these are live programs. We do offer these. We can lock rates against these. So we definitely want to make sure that you guys have these tools in your pocket when you get down there in the field and try to find these people some homes. So the first one that I want to start with is a down payment assistance loan. That is pretty exciting. It's basically treated like an FHA loan. So 3.5% down is the amount borrowed in the form of a second loan. So on FHA financing, guys, the minimum down payment is 3.5%. And this is borrowed like a second loan. So we can go up to about 160% of the area median income. So for example, guys, let's use Comal County, for example, right? The area median income is about $83,500. So the max income for that area would be $133,600. So again, that's you take 160% times the area median income. And for Texas housing, because guys, I know you're probably in your minds thinking, okay, well, comparatively, we do have a Texas housing program, but the income limit for that product is only $106,000 for a Comal County, as opposed to $133,600. So you got to think, guys, that's the difference in only being able to use one borrower's income and being able to use, say, a borrower and his wife, or borrower and their partner's income to be able to qualify them for this. Secondly, something that's super exciting about it is there's no debt ratio limits as long as we have an automated underwriting system approval on our end. Guys, just to kind of remind you, automated underwriting system approval is when we have an entire 1003 mortgage application set up. We send that through our automated underwriting system approval, and it either kicks us back an approve eligible or an approve ineligible. And if we get an approve eligible, our underwriters have to honor that approval when they go to review the file once the customer's under contract and we're able to submit the loan to the underwriter. So just to reiterate that again, there are no debt ratio limits as long as we have automated underwriting system approval, we can do the loan. And then also something else to consider, since this is follows similar guidelines to the FHA programs that we've been offering since day one. The minimum credit score for a single family home is 600. So let me say that again. The minimum credit score that we will accept is a 600 for single family homes. For manufactured homes, guys, it's 620 is the minimum credit score. So that's huge. I mean, you got to think, guys. I mean, since COVID, obviously we've been dealing with a lot more customers that are a bit more credit challenged. So this provides us the opportunity to be able to even get those folks into homes without having to do any sort of rapid credit rescoring or get them in touch with a credit repair specialist before we can get them approved. So let's kind of talk about how this second loan is set up. Let me just pull up the details here. So the second loan is paid back over 10 years. Okay. And so guys, just to do some quick math for you. So let's use a $300,000 home as an example. Okay. So if the mortgage is 300,000, or, if the purchase price is 300,000 with a 3.5% down payment, guys, that means that the second loan that we're setting up that the borrower is borrowing against is $10,500. So the down payment assistance funds against a $300,000 mortgage at 3.5%, the purchaser is going to be borrowing $10,500 in down payment funds. Now, how that works as far as repayment, guys, is basically they have 10 years to pay that off. After 10 years, basically they have a 2% higher rate over that 10 years against that $10,500. So again, let me give you an example. So let's say the interest rate on their primary mortgage is let's say 6.5%. Okay. All you do as far as coming up with the payment associated with the down payment assistance funds is you just take 2% plus whatever their note rate is on their first. So guys, again, let's say their note rate on the $300,000 loan is 3.5%. You just take, or it's 3.5% down. You just take the 6.5% rate that they have on that first, and you just add 2% to that rate. So they're paying back their $10,500 or 3.5% down. They're paying that back against an 8.5% interest rate. So guys, just some quick math for you: 8.5% against 10,500 over a 10-year term. The term is only going to be $130 a month payment. So their monthly mortgage payment is going to go up by $130 because they're paying back their down payment, okay, at an 8.5% interest rate or whatever par rate is. So let's say if the par rate today is 7%, you just add 2% to that rate, and that's what the rate is that they pay their down payment assistance funds back against. Okay. And they've got 10 years to pay that back. Okay. If for some reason, and just to kind of put a bug in your ear, because a lot of customers are going to be curious about, well, what if I'm not in the house for 10 years? Or what if, I decide to refinance? Whatever the balance is of the loan when they go to refinance or they go to sell the home, they will be required to pay those funds back. Okay. So if they plan on netting $50,000 from the sale of their house after 2 years, they're going to pay back. Let's say they only owe $7,000 on their down payment, funds that they borrowed. They will take that money back from the proceeds. So instead of them netting 50,000, they're going to net, 43,000. Okay. So, again, the good news is also on these products, as opposed to say like your Texas housing guys, is there's no max mortgage amount, whereas Texas housing, that may be a little bit higher. And then also these borrowers don't have to be a first-time home buyer, guys. This isn't like a first-time home buyer down payment assistance product. This is available to anybody, right? Whether they've owned a home or not does not matter and does not pertain to this product or their ability to qualify for it. And again, guys, just to reiterate, it's a second mortgage and it's paid back over 10 years at a 2% higher rate than their note rate. Okay. So just again, I'll put an example of this on the Facebook page for you guys to kind of see what that looks like. But in essence, guys, these customers are effectively not having to come up with 3.5% of the purchase price to be able to buy a house today. Okay. And also, now that this is kind of shifting to a little bit more of a buyer's market, I'm sure everybody can agree on that. We're definitely seeing more leverage on the customer side to be able to request things like seller's concessions again, right? The buyers are certainly have a little bit more leverage on their end, especially for homes that have been sitting on the market a bit longer. You guys can even go in as their realtor and negotiate concessions to help them out as far as, even covering some of their closing costs in association with. So these customers could end up, a customer with say $5,000 to their name, they could end up being able to, with the help of you all as realtors negotiating concessions and then being able to borrow this down payment, effectively coming out on a down payment assistance loan with really coming out of pocket with very little money. Okay. And again, with a minimum credit score of 600 on that product, guys, I mean, there's really hardly any excuse why we can't, even go back through our Rolodex, if you will, and try to even scoop out a couple customers that maybe we're putting the process off for a bit. In fear of not having enough money or not saving enough money yet. Okay. So that's the first product, you guys, is that down payment assistance. It's effectively treated like an FHA loan. It only requires 3.5% down, which that's being borrowed as a second loan. Okay. The second time, and then I'll open it up for questions once I'm done, guys. But does anybody have any just based on that first product there? Okay, good deal. So the second product that we want to talk about is the 2-1 buy down. Basically, this is treated like a conventional loan. It's a primary. It's only good for primary residences and second homes, guys. It's called a 2-1 buy down product. Okay. Effectively, what this is allowing is for the customers to pay a mortgage payment onto a lower rate for the first couple of years that they own the house. And I'll get into that here in just a second. So basically how it works is the interest rate is 2% lesser than the note rate for the first 1 to 11 months. So effectively for the first year that the customer's in the house, their interest rate is 2% lower than the market rate. So if the market rate's 7.5%, they're paying on a 5.5% rate. Okay. Then after year 1, year 2, their interest rate is only 1% less than the note rate. So again, for example, for the first year, if their interest rates are 7.5, then the interest rate they're paying on is 5.5. For the second year, if their interest rate is 7.5, the interest rate that, as a par rate in the market, the interest rate that they're paying on is going to be a 6.5% for that second year. So I'll give you guys kind of a run through of an example, and I'll put this again on the Facebook page so you guys have something to refer back to. But let's say the purchase price is $350,000. Their loan amount is $300,000 and their interest rate is 7%, right? For the first year, their principal and interest based on that primary loan, their principal and interest payment should be about $1,995 a month. But remember, you take 2% off of that rate for the first year. So guys, they're saving just in interest on this product for the first year. They're saving $385.45 a month in interest. So instead of, them having a $2,000 a month mortgage payment, all of a sudden they've got, a $1,600 mortgage payment, right? So on the second year, right, their mortgage payment is 1% less than the note rate, than the par rate. And so they're effectively saving a couple $100 a month in that situation for the second year. So what happens is, guys, is if you take the difference in the first year payments at saving $385 a month, that's going to save them about $4,625 in interest in that example that I used. And then in the second year, it's going to save them about $2,400 a month in interest. Okay. You take those two numbers and you add those up, and that money is effectively going into an escrow account separately for them. And, the borrower, if we get seller's concessions, guys, in this 2-1 buy down option. So let's say Paul goes out and says, hey, he asked the seller for $7,000 in seller credits, right? If they do that, effectively that seller credit is being put into an escrow account to buy that rate down for the first year and to buy that rate down for the second year for your customer. Okay. And if you know, again, let's say you all do negotiate the concessions, that concessions just goes into the escrow account. And then whatever is left over in that escrow account, if the borrower decides to refinance or sell, our customers are going to get that money back after closing on their house. So it's going into an escrow account to be given back to the customer. Now let's look on the flip side, guys. Let's say that you guys can't go out and you can't negotiate the full amount of seller's concessions in this situation. Then the customer then has to use their own funds to put into an escrow account to be able to buy the rate down for year 1 and 2. So it's really important, guys, that because in the 2-1 buy down situation, a customer is, because it is treated like a conventional loan, a customer is still required in the 2-1 buy down option, guys, to come up, let's say with our first time home buyer, they're still required to come up with 3% down or 5% down, which is the conventional down payment amounts that are required. Okay. So if you can get concessions for the buy downs, then you're effectively saving your customer, you know, in a situation where they're buying a $350,000 home and putting, you know, let's say $50K down of their own money, but they want a lower interest rate. Your concessions that you're able to negotiate are going to go towards them not having to come out of pocket to buy their rate down for the next 2 years. Okay. Again, ideally, we'd love to have the seller pay and seller credits. You know, if we don't get seller contributions, the contract, and just keep in mind, guys, and I'll put a note about this on Facebook, but keep in mind, guys, that the way the contract has to be written up in these 2-1 buy down situations is that we have to notate in the contract that the contributions from the seller can only be used for the purpose of buying down the rate. So for example, in Texas, let's say the closing costs are normally about 2.5% of the purchase price or 3% of the purchase price. So let's say an example of a purchase price of $350K, your closing, you know, a customer's closing cost could be anywhere from $8 to $10 grand realistically. So the borrower not only has to come up with their own down payment in this situation, but they also have to, you know, obviously cover their own closing costs outside of the concessions. Because you have to remember, if you're asking for seller's concessions in this situation, those concessions are only going to be used for the purpose of buying their rate down over the next 2 years. Okay. But guys, you got to think that makes a hell of a difference. I mean, you're talking about saving these customers, you know, $6,000 or $7,000 in interest over 2 years just by lowering their rate. And obviously that amount's going to vary based on the purchase price and and the amount that they actually finance and the amount that they put down, so on and so forth. Guys, you're going to see maybe some information online about other buy down options being offered. I mean, 3-2-1. You know, we only offer the 2-1 buy down at this time. If we do decide to roll out any other products that maybe go into a 3-year term, we'll certainly let you guys know. But for right now, it's just the 2-1 buy down option. Again, just to reiterate, the rate's 2% less for the first year and 1% less for the following year. Okay. Again, keep in mind, guys, that let's say you guys do get the seller's concessions to help them out in this, that those concessions of let's say $7,000, those $7,000 in concessions go into an escrow account, and then the escrow account gets reduced every single month based on how much the buy down costs every single month against the rate. So, you know, again, if they sell the house, if they refinance the house, whatever amount is remaining in that escrow account for the purpose of the buy down, they will get that money back. So if you get concessions for them and they use the seller's concessions towards that, then effectively your customer is going to get free money after they sell or refinance. You know, again, ultimately, guys, all we're doing is we're financing a particular amount of money into an escrow account to reduce their monthly mortgage payment for the first 2 years that they own the home. Okay. So that's the 2-1 buy down option is that. Okay. Does anybody have any questions about that? Okay. So guys, again, I'll put all of this information online for you guys. Again, there's two products. There's down payment assistance. It's basically an FHA loan, 3.5%, and 3.5% of the down payment is borrowed and then repaid by the customer. Okay. And they have 10 years to pay that back. The 2-1 buy down option is us putting money into an escrow account to lower their rate for the first 2 years so that their monthly mortgage payment is much more affordable. I mean, guys, I'm sure you're getting this a lot right now where you go show a customer a home and they're like, and then they find out what the monthly mortgage payment is and they're like, no, that's not going to work for me. Well, this 2-1 buy down product can really help at least create an affordable situation for them, because ultimately, guys, most people right now, anybody who's bought a house since January 1 of this year, any loan that we're writing on right now is really like a bridge loan, or what I call a lily pad loan. They're just going to be with this loan for a moment until rates drop and then refinance and take advantage of lower interest, lower their monthly mortgage payment by $200, $300, $400 a month, depending upon where rates do end up falling at. The problem is, guys, is we don't really have the luxury, us, you all as agents, me as a loan officer, to sit around and wait for rates to drop. We don't know, when that's going to happen. And we can't sit around and just have customers fall by the wayside because they feel they can't afford the payment for now. Ultimately, there's a lot more value in the homes. I'm sure everyone would agree in this call. There's a lot more value to be had in the homes that are on the market right now. We're not in the COVID era where, for those 2 years, people were overpaying $25, $75, $100,000 more over asking price to buy a house, thinking that it may be worth that, right? I mean, these homes that are being listed right now, we're seeing some price cuts. We're seeing that these homes are actually worth what people are willing to pay for them right now. And so we have to incentivize these customers by saying, hey, listen, you don't have to empty your piggy bank to buy this house. And you certainly don't have to feel strapped with a higher mortgage payment that you weren't necessarily anticipating for the first 12 to 16 months. So guys, this is really just creating alternatives for us to try to get, roofs over people's heads for the time being. And once we're able to do that, we're going to be able to maybe see a little bit more success. And again, don't be afraid to tell these folks, guys, these are lily pad loans. This is going to be a loan just to get you into the house so you can afford the payment for now, so you don't have to empty your account for now. And you're not married to these loans. There's always an opportunity to refinance. And when that time comes, guys, you send those deals over to us. We'll be able to save them on interest. And all of a sudden, these people who bought houses for what they were worth during these kind of tougher 12 to 16 months that we're dealing with right now, they're going to be able to take full advantage of lowering their interest and putting themselves in a position to where they can, continue to save money and build equity in their homes for the future. All right. Again, any questions about either of those programs, I'll put all these notes on the Facebook page, guys, so you can refer back to them. I'll put these kind of little example scenarios for you all as well. But does anybody have any questions about, the down payment assistance product treated like an FHA loan, or the 2-1 buy down program as it pertains to primary residences and second homes?
I do.
Go ahead. Vanessa.
Yeah, go ahead.
All right. How does this pertain to the VA loan?
This is completely separate from the VA loan. So Vanessa, VA financing, they don't have to put any money down. So that's 100% financing.
I understand. That's interest.
What's that?
As far as the interest go, because the VA loan still offers to pretty much, the interest rates are still the same according to the market.
Yeah. So VA loans are just a completely different product. So there's no down payment assistance products as it relates to VA, and there's no interest rate reduction products as it relates to VA. So VA, generally speaking, always has about a 0.5% lower rate offering than conventional loans, and is generally on par sort of with FHA financing. So if FHA 7%, VA may be 6.75 or 6.875. It's generally always around where FHA rates are at. Conventional obviously is going to have a higher rate than your VA loans, but as far as rate reduction as it pertains to VA, there are no products to my knowledge that exist with that.
Nice if we had a rate reduction plan for veterans. There's a lot of veterans in Texas, as you know, and I'm working with a lot of, they're pretty much priced out now, even though. Yeah,
I think again, down payment assistance products in particular don't really pertain, just because, again, VA is 100% financing. So these customers aren't having to put, their money down to buy the house anyway. And so I think, like, although yes, rates are high across the board, VA is still a superior product than most others. I mean, right now for any type of buyer, first time home buyer, consecutive buyer, situations like that. Again, these are products really for the average consumers who may only have $3,000 to $5,000 to $7,000 total saved up. That's really not going to cut it in Texas. Hell, that's not even going to cover, the closing cost, So these products are really helping those folks be able to afford houses today. If we do find out that something is rolled out as far as rate reduction as it pertains to VA, we'll certainly let you know. But for now, there's nothing that exists that I'm aware of.
Yeah, that would be wonderful if there was an interest rate assistance program or a lower interest rate product, with a VA loan, we could get a lot more veterans who are already qualifying.
I mean,
mortgage. That's what I was trying to refer to.
Got you. Yeah. I mean, again, they don't have to come to the table with a down payment. And then if you as the agent can somehow negotiate seller's concessions, then they can basically buy a house for free.
Yeah.
So I don't know of a better deal than that exists out there. So, again, I think it's us really marketing the fact that VA customers don't have to put a down payment down. And if you, again, we're in a particular situation now, Vanessa, where you all as agents do have a bit more leverage to be able to negotiate concessions from the seller or contributions from the seller to lower, in a situation I just mentioned with the 2-1 buy down, to lower these customers' interest rates as it pertains to VA customers, cover their closing costs so that they effectively can get a house for next to nothing. So
that's one. Well, thank you, Ryan, for answering my question.
No problem, Vanessa. My pleasure.
All right.
Does anybody else have anything?
Yeah, Ryan, is there a prepayment penalty for the down payment?
There's not. No, I mean, the only, again, with the down payment assistance program, again, I guess in effect, Mickey, the penalty would be that if they haven't paid it off in full already and they pay the loan off early, then they have to, like, let's say, for example, in a refinance scenario, and let's say they still owe $8,000 against the down payment that they borrowed with the down payment assistance product. Those funds would have to be taken out of the equity to pay that back. So there is, I guess, in essence, there is prepayment penalty in essence that if the loan hasn't been paid off in full yet, then it's paid back when they go to refinance or sell.
I mean, is there a prepayment penalty for the down payment loan itself?
Oh, no. If they decide, I understand your question now. Yes, if they decide to go ahead and pay that off in advance, there's no prepayment penalty on that.
Because if it were me, I would want to pay that higher interest rate payment, that higher interest rate loan off first.
Yeah, absolutely. So, and I think that's going to be most people's prerogative. I mean, also, I mean, keep in mind, somebody gets a tax refund and they want to throw $6,000 at that, they can do that without any penalty.
Okay.
Yeah. Yep.
And also,
I think that just helps them when they go to sell or refinance, because that means most people they're not going to stay in a house for 10 years to pay this second off, right? So most people are going to have to either A, pay it off in advance, or B, stomach the fact that whatever their balance is when they go to sell or refinance, that's going to be taken out of their equity.
Right.
So to satisfy that balance. Good question, Mickey. Thank you. Does anybody else have anything for me?
I don't think so. As long as you go ahead and put those examples on the Facebook page, and I'll throw this recording up on the page later today.
Wonderful. Yeah, guys, I appreciate you all taking the time to learn this and to hear me out. I mean, we're really excited about these alternatives. Again, we're in a situation where it's time to get creative. We really need to try to figure out ways to get roofs over people's heads. This is one way to do it. I mean, one of the biggest setbacks so far this year for me personally as a banker has been the fact that most people aren't doing well post-COVID. right? They don't have the same money that they have saved up. Their credit is challenged because, maybe they weren't able to pay their bills on time due to furloughing or whatever the situation may be. So this is really going to be a situation where if we can find customers who are motivated to buy houses, these two products are going to provide them the opportunity to do that today. Okay, so I'll put this information online. If anybody has any specific questions or need me to provide any further examples, or maybe you just want to chat about these products with me, feel free to call me on my cell, shoot me a text. We'll get you on the schedule and we can talk through this a bit more. But otherwise, guys, I do appreciate everyone's time. And if anybody needs anything from me, don't hesitate to reach out and we can we can try to help you out as far as this goes. Okay. Awesome. Hey, listen, everybody, have a great day. I appreciate you.
You
Thanks,
too.
Rob.
Thank you.
All right. Take care.